Welcome to part two. This is the exclusions chapter. And I often like to say, like, oh, this chapter is really important um, because it has exclusions, right? So if there's one thing taxpayers like, it's deductions. If there's something they probably ought to like more, it would be exclusions. So because obviously, if I don't have to include income in my gross income, that's as good as a deduction. It's mathematically the same anyway. Okay, all those are second to credits, right? We love credits most. Giving credit where credit's due. Let's keep going. Okay, so exclusions from income. Recall that we have this broad definition of gross income. It pretty much says from whatever source derived, unless it's excluded. And this chapter is about excluded. And remember, the term excluded also can include things that are deferred as well. We kind of use that term interchangeably. So I absolutely love how the book hits you with this complex tax concept right away about corporate distributions. And if you're able to take the corporate class, Accounting 651, we really go in on this. But we'll dig in later, even in this course when we do corporations. So corporate distributions generally treated as a dividend, technically only if it comes from earnings and profits or E&P. If the distribution exceeds E&P, then it's considered a return of capital. And then once the shareholders' basis in those shares of stock is exhausted, right, if you're returning its capital, reducing your basis, then it's eventually treated as a capital gain. And as I said, we'll reinforce this pretty dramatically when we get to the corporate chapters later. Okay, a corporate distribution of its own stock, not considered taxable. So let's say Gene owns 100 shares of GW Corp, which is just so we're sure it's all the outstanding shares. And GW does a 2-to-1 stock split. And so now for each share you used to own, you now have 2. Did anything really change? And the answer is no, right? Gene owned 100% of that company beforehand. Gene owns 100% of that company afterward. And even if it was, 1/3, 2/3, everyone would still own 1/3 and 2/3 under a 2-to-1 stock split because everyone's ownership is the same. Ownership percentage is the same. It's like instead of having one piece of paper, we said, "I'll cut it in half," and now every share of stock is 2. It doesn't really change anything. And so typically a corporate stock distribution is not considered taxable. There are situations where it is, where it could be cash or stock, for example, but we're not going to dig in on those. Gross income, at least not in this class. Gross income, gifts and inheritances. Gifts are generally considered tax are excluded from gross income. So what you end up with is a battle of like, oh, it's a gift. Let's not treat that as taxable. But you got to be able to separate a gift from a taxable transfer. There's a court case named Duberstein. The Supreme Court used the term disinterested generosity as something that's required to be a gift. That's generally not available on payments from an employer to an employee. It's also very difficult, it can be true if they're related persons, which kind of is backward. But imagine your dad owns the company and you get a gift because you work there. There could be disinterested generosity, meaning you did it because you love them as opposed to because they were a good employee. Otherwise, pretty much payments from employer to employee are almost always treated as compensation. I say that over and over again because it's true. Got to drill that in you. Employee death benefits under limited circumstances can be excluded. Military death gratuity is not taxable. So there's a couple ways that an employer can pay off the family or descendants of an employee, and that can be excluded. I won't dig in a lot on that. The book does a decent job with it. Life insurance policy benefits are generally not taxable. So, for example, if I die, I have an insurance policy. Let's say each of my kids gets $100,000. They won't pay any tax on that $100,000. Generally speaking, it's not taxable, but there are situations where it can be. The first is if I have one of these whole life policies, and so it has an investment component to it, and I decide that I'll exchange, I'll give back the policy before I die, right? Hey, you know what, never mind, I don't want life insurance anymore. Give me the cash surrender value, which think of that as the investment that's built up over time in the whole life policy. Then you actually would recognize potentially gain. You don't get to recognize loss if the cash surrender value is less than your premiums. So, it's almost like you're exchanging it back with the life insurance company. And so they treat that as a disposal. They just disallow the losses. There is an exception if you're terminally ill. So, let's say you got lung cancer and the doctor can say, hey, yeah, this dude's going to die. Then it's kind of like, well, you always have the option then to turn your policy in for its cash surrender value, kind of under the guise of, look, you're going to die anyway, let you enjoy the money. And so that's excluded, right? You don't have to recognize the gain when that's the situation. So besides selling it back to the life insurance company, there's also situations where you could just sell it to a third party, right? So I have a life insurance policy on myself, and I decide, I'm not really interested in keeping it any longer. But I have a good friend who's hoping I'm going to die, right? So think of it like the guy that tends the bar in Deadpool. So he's got a vested interest in my death. So he buys the policy from me and keeps paying the premiums in hopes that I'm going to die. Let's say not in hopes that I'm going to die, but he just wants the policy to remain. Well, when you sell something, right, sale, exchange, or disposition, you're generally going to generate some realized gain. And in this case, some recognized gain as well. And if that person, what happens is, if that person holds the policy, when it pays off, and it generally will pay off to them, right? Then what happens is the amount they pay plus their premiums represent their adjusted basis in the policy. So whatever the benefit is, let's say it's 100,000, but they bought it from me for 60 and they've paid premiums for 10. Then the 100,000 minus the 60 minus the 10, so minus 70 would be 30,000. That would be their gain. Scholarships are excluded. I know students really love that, but it must be used for qualified tuition and related expenses. So tuition, fees, books, supplies, required equipment, room and board does not qualify, and it must not require any performance of services. So, for example, you can't come with a handcuff that says, hey, and you've got to work in the cafeteria to get it. No, that's not permitted. There are tuition reduction programs for employees of universities. So when we get to fringe benefits, you'll see it's a little bit like an employee discount, or maybe even like a no additional cost service. But whatever the case is, they're excluded. So if my dependents, for example, go to San Diego State, I get 50% off the state fee for them each semester. And so I get, a tuition reduction program that would not be considered taxable income. It's excluded. It's only for undergraduate education. If one of my kids went to SDSU to get a grad degree, like a master's in accounting, they would not be eligible for the tuition reduction program. There are situations where graduate students are, and it's generally when they're PhD students, so they're engaged in teaching and research as well. That's when the tuition reduction is excluded. Okay, so payments for damages. This is your kind of, I sued you in a tort for some sort of, for damage that you did to me. So breach of contract, that's almost always taxable. Property damage is treated like proceeds against your basis in whatever the property was. And when we get to casualty losses, you'll see that to some extent it represents a casualty loss with insurance proceeds to help cover the loss. If you end up with a loss, I mean, it's a gain, it's taxable, right? If you end up with a loss and it's business property or investment property, you can take the loss. But if it's personal use property, it's only deductible if it meets the definition of a casualty loss. And again, we'll get to what a casualty loss is when we do itemized deductions. If the amount you sued for was for personal injury that is of a physical nature, right? Something to your body, a medical expense, those are considered excluded, right? So, if you're in an accident and you're damaged and you got to go to the hospital and get plastic surgery, and just a trip to the hospital alone is expensive enough, right? So, whatever you receive in compensation for that is excludable. However, punitive damages, those are included in gross income. So to the extent you sue for punitive damages, which most states allow for that, at least to some degree, the idea is to like punish the wrongdoer so they don't do it again. Those are taxable. That's gross income. Non-physical injuries, you're out of luck. Those are pretty much just all included in gross income. So when I think about this, I carve it down and I say, look, if there's an injury to your body, that's when you can exclude it. Pretty much all other settlements are taxable. So what happens is there's been, a number of arguments around what is a physical injury, and pain and suffrage, for example, do not qualify. Emotional suffering does not qualify unless it's associated with a physical injury. So, let's say that you were in a car accident and you had to have your leg cut off, and it was a very painful, traumatic experience. And as a result, the fact that you had to have your leg amputated, that is what's causing your emotional damage. That's when you'd be able to tie it to the physical injury. More general cases of that have not withstood the ability to exclude in the court systems. All right. Payments for wrongful incarceration. You go to jail and you shouldn't have been, and then they pay you off because it was a mistake. Those are excluded. That really kind of only seems fair to me. I've not spent any time in juvie, but if I had, and it was wrongly, I think I would want to have been compensated for it and not pay tax on it. Workers' comp payments are excluded. So you get injured at work, and your employer's workers' comp kicks in. Whatever that is excluded, even though that truly is income replacement money. Usually, it doesn't matter. The Congress has just said, you know what? If you got injured at work, we're just going to let you exclude it. Accident and health insurance. Sometimes you hear this called disability insurance. So I'm gonna separate this to some extent, but not entirely, from health insurance, right? Medical insurance. But if paid by the taxpayer, the benefit payments are excluded. So if I pay for my own disability insurance, which I don't, by the way, the state of California pays for mine. But if I did, when I was a CPA, I did in fact pay for my own disability insurance. If I somehow was disabled and started receiving benefit payments, those would be excluded. If, on the other hand, in my current situation where my premiums are being paid by my employer, the benefit payment, if it's for medical care, I could exclude it. If it's for physical injury, I could exclude it. But if it's pretty much for anything else, like lost income, I'm unable to exclude that, right? I would have to include that. There are things called medical reimbursement plans. So the most popular one standing today is something called an HSA, or a health savings account. And this kind of operates like a lockbox. So what happens is I can take money out of my pay, right? So my employer runs an HSA account, or I'm self-employed and I can set up my own. And I take money out of my income and I put it in the HSA. The first thing is I can exclude that portion of the income. And then secondly, it sits in what I like to describe as a lockbox. It goes way back to Al Gore when he ran for president, and he was going to treat Social Security like a lockbox. In any event, it is treated like a lockbox. Your money's in there. It's growing, but it's not taxed, right? So it's locked away from taxation. And as long as you pull it out and use it for medical expenses, qualifying medical expenses, you never pay tax on it. So it's kind of like, having your employer just directly pay for medical expenses. Well, since that is in fact excluded, going through this lockbox system where you're kind of using your own money works the exact same way. There are some limits. The maximum contribution is adjusted for inflation each year. For 2022, $3,650 if you're single, $7,700 for family. So as a single taxpayer, you could set aside $3,650 each year to go into your HSA. And then you pull that money out. You wouldn't include the money in your income, the $3,650, and then you'd pull it out and spend it on medical costs, and you would not have to include it then either. So long-term care is an insurance policy for, when you're old and unable to care for yourself. Largely you can think of it as paying for a nursing home or assisted living or something along those lines. The rules are generally the same as they were for accident and health. Employer paid is excludable. So if your employer pays your long-term health care insurance premiums. That's excludable. The benefits are excludable as well, but there are limits. There's also limits on the amount of the premium that can be paid. What they don't want is for you to create a life insurance policy out of a long-term care policy by overpaying premiums and then there being something left over. So they put a cap on the amount of premiums that can be paid, and those depend on the age, and those are also adjusted each year for inflation. So I'm never going to make you memorize those things. If the premiums are paid through a cafeteria plan or a flexible spending account, strangely enough, those are not excludable, and we'll cover what a cafeteria plan and FSA are in a short time here. The per diem benefit is capped at $390, and again, that number gets adjusted by inflation. And amazingly, it's lower this year than it was last year. It was $400 last year. So that's the amount that the policy can pay on your behalf. And have it remain a excluded payment back of your benefit. Okay, another excluded item is when an employer provides meals or lodging to an employee, but this is only true in certain circumstances. First is the meals and lodging must be furnished by the employer on the employer's premises, and that must be done for the convenience of the employer. And if it's lodging, on top of that, the lodging must be required as a condition of the employment. So the implication is, look, it's for the convenience of the employer because I need you to be on call, right? And so I don't want you leaving, and so I'm going to provide meals to you so you don't leave. The lodging is, well, you can't leave, right? Like I'm required. You want this job, you have to stay here. And so you get some arguments about what it means to be for the convenience of the employer because, that's a little bit of a squishy definition. So largely, if it's primarily to enable the employee to perform their duties, and there's a substantial non-compensatory business reason to do so. So a common one would be, let's say you're going to work on an oil rig out in the middle of the Gulf of Mexico, and the way you get back and forth is either by boat or by helicopter, and both of those are long commutes. You're hundreds of miles from the coast. Well, it's clearly for the convenience of the employer for you to stay. So they're going to provide meals and lodging for you on that oil rig. That's not a compensatory reason. That's just because you can't work on that rig without that being the situation. Like you can't commute back and forth. It's just not reasonable to do so. So that'd be one reason. Like another one is hospitals sometimes require doctors to stay on call, and so they'll provide meals for them at the hospital for the convenience. There's a handful of special rules that have been kind of tapped out over the years through either administrative regulation or the court cases. So if a meal's furnished before, during, or after their work period, so if it's during, it's almost always non-compensatory. But if it's before or after, and by before or after, I mean not immediately before or after, then that usually is compensatory, right? So let's say you work at Mr. A's and you decide, one day you want to take your significant down there, your significant other down there for a nice meal. And the management at Mr. A's is like, oh, we love you as an employee. We're going to comp you the meal. That technically would be compensatory and would need to be included in your wages. Again, if the employee is required to live on the employer's premises as a condition of the employment, for example, something like a super that works in an apartment building, they often provide them lodging. And the idea is, look, you're there to, fix the plumbing when it breaks. So you have to live there. Is the meal furnished during working hours so that you're able to respond to emergencies, right? That's kind of the doctor thing, if you will. If it's furnished during working hours because the meal period needs to be so short, there's frankly not time to go somewhere else. So that would be, for example, the oil rig, right? You can't get in your boat and drive it hundreds of miles back to the coast, eat lunch, then get back in and drive back to the oil rig and keep working. If it's furnished during the employee's working hours because they cannot otherwise secure a proper meal. So this is if you're in a really isolated place. So imagine, for example, a prison guard, right? Prisons are often removed from mainstream. You might not find, McDonald's outside the prison. And so they may provide food there because it's a long way to get food anywhere else. Food service employees definitely get a break. Pretty much any meal served to you during your employee work period or immediately before or immediately after is excluded. If you furnish meal to promote the employee's goodwill or morale, so that sometimes is a celebratory meal. So in like accounting or tax, sometimes you'll have in tax it might be an April 15th party, or maybe you guys wrap up a big audit, and so the whole audit team goes out and eats lunch or whatever. As long as that's not of too frequent of a fashion, that generally would be considered excluded. Meals furnished to attract prospective employees, right? So a recruiting lunch, pretty common, right? And excludable. Is it furnished under an employment contract or statute that characterizes the meal as compensation? Because in that case, there's no choice, right? It's just compensation. So don't need to argue with that. Oh, here's some examples where we really already walked through those. So again, payments from an employer to an employee, we almost always consider these gross income, right? Whether it's paid as salary, wages, bonus in kind, property, services, etc. It's really hard to disguise a payment from an employer to an employee as anything but compensation. There are some things that are carved out: healthcare, life insurance, disability premiums, some of those we've talked about. I mean, there are other benefits that are excluded for administrative reasons. And so basically, there is a subset of compensatory payments from an employer to an employee that if they qualify as a qualified fringe benefit, they can be excluded. Now, most fringe benefits you think of as being taxable. Hey, you were the best salesperson of the year. We're going to fly you to Tahiti. That's absolutely taxable. That's a fringe benefit. It's a taxable fringe benefit because it's not part of a qualified fringe benefit. So again, since taxpayers love things that are excluded, we need to walk through what these qualified fringe benefits are. So child and dependent care expenses are one of them. Your employer can help you pay for your child or dependent care. It can be withheld from your pay on a pre-tax basis, or your employee can pay it directly, or they can even own their own daycare center and let you go there for free. The maximum amount you can exclude is $5,000. In 2021, they expanded that to $10,500. There was some sense that they were going to try to make that stick permanently. It did not work. As you know, we got a watered down bill in 2021 relative to what the Democrats wanted. And so we don't seem to be going back to $10,500 anytime soon. I will tell you, my oldest son is 25 years old. So at least 25 years ago, it was still $5,000. The idea that they haven't adjusted that $5,000 number for inflation is a little bit ludicrous. It's probably due to be adjusted, but that does, cost money. Gyms, if they're on the employer premises, are excludable. So you can have a gym for your employees, their dependents, their spouses, retired employees. The way you taint that is you allow the outside world, you allow third parties to come in as well. So you can't own a gym and charge people from outside the company and let the employees do it for free and hope to exclude that. Once you allow fee-paying members in, then it's taxable to your employees. There's something called an education assistance plan. We'll dig in on that in a little bit, where your employer can help you pay for your college tuition. I was the beneficiary of that. I received $5,250 for 2 years to help me pay for college when I was a young adult. Adoption assistance programs. There's a reasonably lucrative exclusion of almost $15,000 in 2022. That's a inflation adjusted amount. By the way, the $5,250 is not. It also has been around again since I was a young adult, since before I had a kid, and it's never been adjusted. But the adoption amount is adjusted, and so not only can your employer pay you up to $15,000, and you can exclude that. If you spend more of your own money, you can double that through a credit. There's a very lucrative tax policy around adoption, and I assume that's driven by the hope that people will adopt needy children. So there's something called a cafeteria plan, and this actually has nothing to do with food per se, but the idea is rather than offer a set number of benefits. Instead, what happens is your employer says, hey, here's 7 things. You can choose 2 of the 7, 7 of the 7, or none of the 7. And whatever you don't take as a benefit, we're just going to give to you in cash. So a lot of times we think of these as like a cash or deferred arrangement, a CODA arrangement. So employee A might opt for the dependent care benefit. Hey, I want 5,000 to go towards my dependent care because I've got kids. But employee B is single and childless and says, hey, I'll take the cash, man. I'm going to go on vacation with it. So both of them can remain excluded, or sorry, A remains excluded. Once you opt for cash, that's taxable, but that's really no surprise. There's things called flexible spending accounts. I've already referred to these once. We'll talk about those more later. So what is the biggest fringe benefit? Without question, monetarily, it's the health insurance exclusion. To the extent your employer pays for health, accident, or disability insurance, it's all excluded, right? So your employer can just just pay your premiums, flat out pay your premiums, and you don't have to include that. They can also buy life insurance, as long as it's group term life and it's for everyone. But they can only buy you up to $50,000 worth, right? Anything more than that, and it's starting to think, well, wait, this is not just to stick you in the ground or burn you up when you die. This is maybe a little bit more than that. And so anything in excess of 50,000 actually does generate a benefit. And you would include that in gross income, the benefit associated with the amount over 50,000. And they provide a table, right, that you use to calculate, for every 1,000 you have of insurance over 50, how much you have to include in your employee's income. So there are others, no additional cost fringe benefits. The classic example is airlines that allow their employees, spouses, and dependents and retirees to fly for free when an empty seat is available, right? If they allow them to reserve those seats, then there's no exclusion. And it only works with a specific line of business. So if an airline owned an airline and a hotel chain, if you're an employee of the airline, you get the no additional cost fringe on the airline, but not the hotel. And if you work for the hotel, you might get the free hotel room, but you're not getting the free plane trip. Qualified employee discounts, as anyone who ever worked during the holiday season knows, when do you work at Macy's, Thanksgiving to Christmas, why? So that way you get the employee discount. If you apply a discount, it's excluded as long as it doesn't force the employer to sell those items at a loss, right? So they have to be selling it at least break even to their employees, or else they're transferring value beyond just the cost. And so the rules say you'd have to include it. For services, you just can't have more than a 20% discount, right? No matter what it is. If your discount is greater than 20%, then you have to include the amount above 20% in the employee's income. Working condition fringes. These are items an employer pays for their employee, but it would have been deductible by the employee if they paid it anyway. And the classic example is kind of like dues, subscriptions, memberships, credentials. So, if your employer pays for you to be a member of the AICPA or the Cal Board of Accountancy, those are all kind of working condition fringes that are excludable by the employee, and the employer takes a deduction for it. And then there's de minimis. De minimis fringe benefits are ones that are just administratively difficult to track by employee. So let's say you have a coffee machine, right? You give free coffee to everyone. Are you making everyone, log in how many cups they had each day, whether it was decaf or caf, how much sugar they used, how much equal, right? No, like everyone just takes coffee because it would be a pain to figure out, who's taking how much and so like de minimis is excluded. Of course, every once in a while, you use your copy machine at the office to make personal copies. That's a de minimis. The other thing that is a de minimis is when you operate an eating facility for your employees. So you operate a subsidized cafeteria. That's considered de minimis fringe benefit. not a 119 fringe benefit, which that's the one where, meals and lodging are for the convenience of the employer. This isn't necessarily for the convenience of the employer. It's just on the employee's premises. That's excludable, but the deduction is only 50%, and then it goes to 0% in 2026. So to the extent the employer has a subsidized cafeteria, they can only deduct 50% of the cost of that cafeteria, and pretty soon they won't be able to deduct any, but it will be excludable for their employees still. There's a qualified transportation fringe benefit that your employer can pay for the use of a commuter vehicle. These are these carpool vans that you see. They're not that common, but you do see them. A transit pass. We live in California, so except for San Francisco, using mass transit is a pretty uncommon thing. But on the East Coast, it's much more common to buy a subway pass or a commuter rail pass or something. And those are excludable. And parking. That is something that you do see in kind of any major urban area where you got to pay for parking in town. Your employer can pay for that parking. There is a cap of $280 per month in 2022. That number is adjusted by inflation each year. All those items are now non-deductible by the employer. They are not deductible. So again, if you lived in a city that had a lot of mass transit, your employer can run a program where you pay for your transit pass with a pre-tax deduction out of your pay. So what happens is, let's say your pay is $200 for the week. They could reduce your pay by $100, buy your bus pass with it, and you wouldn't pay tax on that $100 you used for the bus pass. So that's a little bit of tax savings, right? Not quite the same as them just flat out paying for it, because in a way you're paying for it with your own money, but you are excluding that from your income. So we talked about these educational assistance plans previously. You have to have a plan document to run one. You can't just be like, oh, I'm going to give you $5,250. When we talk about whether you can discriminate in favor of high income employees, as you can imagine, absolutely not on this one. And in theory, it must meet the business deduction requirement, right? So it must be something that's helping your employee do their job better, and not train them for a new job. So, we'll talk about that further when we get to deductions. The maximum is $5,250 a year, and again, that hasn't been adjusted for inflation in forever. They can also provide employee training, of course, right? So, continuing professional ed is what CPAs usually get. That's what we kind of think of as our training, but it doesn't have to be that, right? They could say, we want people to be CPR certified, and so we're going to send you to training to get CPR certified, so that everyone's safer when something goes wrong at the factory. The employee training needs to be required by the employer or the law, right? You can't just be like, oh, that undergrad degree, oh yeah, that was training, right? You get where that's coming from. And it should be able to maintain or improve existing skills, not develop new ones. Flexible spending accounts, this is what the third mention of these. So these operate like a lockbox. Remember, the HSA operates like a lockbox, and the money's excluded from your pay when you put it in there, your contribution. And then as long as you use it for whatever the flexible spending account is arranged for, it comes out tax-free. So right now there's a healthcare one and a dependent care one. Again, you can set aside pre-tax money for either of these. The $5,000 for dependent care is non-inflation adjusted. The healthcare FSA is $2,850 for 2022. That one is inflation adjusted. There are some fairly steep restrictions on its use in terms of if you set aside unlike a health savings account, if I set aside $2,850, I need to spend $2,850, or else I lose the money. It's a use it or lose it kind of plan. There are some grace periods that exist, and you can also roll over certain dollar amounts. Those are subject to whatever the plan wants to do, but the IRS does have limits. I think the limit on a rollover is $500, and I think the limit on a grace period is 2.5 months. A lot of that got extended during COVID, though. Okay, so as I mentioned before when it came to parking, so non-discrimination is a cornerstone of receiving qualified fringe benefit treatment. And so you can see there aren't many that actually allow discrimination. The vast majority of fringe benefits require that you do not discriminate for high income employees. There's a foreign income exclusion. This is one of the greatest benefits ever if you work overseas. So this came from years ago where there was a sense that working outside the US was a detriment. And so we'll just let you exclude income. And it's still around. So if a US resident works overseas, the presumption is you're paying foreign tax. And even though there is a foreign tax credit system and all these other things, rather than deal with that, they said, hey, we'll just let you exclude a certain amount of your income from U.S. taxes. For 2022, that amount is $112,000, and it is adjusted by inflation. If you take the foreign income exclusion, not only can you not take the foreign tax credit, but if you ever look through the instructions of just about any calculation of modified AGI for purposes of being able to take a deduction, if you take the foreign income exclusion, you either add it back or you're simply not eligible for that item. So if you ever see instructions that say, did you file a form 2550, that's what they're talking about. You must be a bona fide resident of that foreign country for at least a year, or 330 days overseas in 12 consecutive months. And temporary departures don't count, right? And then if you're only there for 330, then what happens is you prorate your income based on the number of days in the tax year. So for example, if you left halfway through 2022 to live overseas, you can't apply the exclusion to all of your income, right? Because you were really only overseas for half the time. All right, so interest from state and local bonds, or sometimes we call them municipal bonds, is of course excluded from gross income. Just an important note that interest on U.S. government debt is the opposite. It is generally taxable federally. Most states do not tax interest on U.S. government debt. You can't do it through an income tax. Technically, you can do it through a franchise tax. So you'll see some corporate taxes include a tax on government debt, but for individuals, it's generally not taxable by the states. But it is by the feds. So more education stuff. You can buy U.S. savings bonds, and then if you use the interest for college education, you don't have to pay. You can exclude the interest. The problem is U.S. savings bonds pay so poorly that it's not hardly worth it. So this only applies to Series I and Series EE bonds. Now, the good news is the rates on I bonds are way up. And so actually there's something to be said just recently for maybe going back into this U.S. savings bond system. The maximum you can buy is $10,000. So, even if it's paying 8%, that's still only $800 a year. It's not a ton of money, relative to college tuition, but it is a little more attractive than it was when bonds were paying nothing, including I bonds. So Section 529 is a qualified tuition plan. This is another lockbox. So this lockbox doesn't let you exclude any of your contributions, but it does exclude all the income that you generate. So kind of the idea is you want to save for your kids' college. So, when they're 2, you start putting money in this account. And of course, you keep putting contributions in, but it also keeps growing, right? You invest it and it's making interest and dividends. You don't have to pay tax on the interest and dividends as long as you use it for qualifying higher education expenses. They've added a couple things to qualifying higher education expenses. First is private school tuition for up to $10,000. That's not per year. That's per lifetime. And I better check that. Now I'm not so sure. I'm second guessing myself on that. That could be a per year. The student loan one, though, the $10,000 to pay student loans, that's absolutely a lifetime cap. And so, what qualifying higher education expenses is, what exactly that means has been broadened over the past few years in an attempt to kind of allow other people the option to save for some of these costs. The private school one, that's just flat out a Republican play. The student loans, flat out a Democrat play. So I get it. All right, Coverdell plans were the predecessor to 529 plans. I think technically they're 530 plans, Section 530, but they were limited to $2,000 a year. And because that limit is so low when you think about the cost of education, when 529 plans came around, they just made them obsolete. So I had one of my oldest has a little bit of money in a covered health plan, and that's because 529s weren't around yet. And so I'd saved a little bit of money. It grew all that time, and we're slowly bleeding it out on his community college tuition now. Able accounts is kind of a modified version of a 529 plan. So again, 529, think of it as you put the money in, it can grow. When you take it out, as long as you use it for higher education, it's excluded. Well, the 529 is basically operates the same way. You can make contributions in, you can't deduct them. It can grow, it can grow, and it can grow. And as long as the withdrawals are used for qualified disability expenses, they come out tax-free. So frankly, this is a way of, let's say you have a disabled child and you know that they're going to have special needs later in life. But of course, you're going to die because we're all going to die. News alert. In any event, you can start setting money aside for their future, and it can grow tax-free during all that time. And you see all the items that are included in qualified disability expenses. It truly is a broad definition. I think this was really good tax policy from a societal perspective. I was pleased when they introduced this. Cancellation of debt income or forgiveness of debt income, right? You're definitely better off if someone forgives your debt. As a result, the code treats that as taxable income or gross income. But there are a bevy of exceptions, and a couple of them are really important. The first is if you're insolvent or bankrupt, right? So this is your liabilities exceed your assets. Insolvent means you haven't actually gone forward and claimed bankruptcy. You just have to be able to demonstrate you were insolvent. So if Bill's liabilities exceed his assets by $10,000, but he has $17,000 worth of loan forgiveness, he can only exclude the $10,000 of cancellation of debt income, because once he's done that, in theory, he's solvent again. Whereas if he flat out declares bankruptcy, he can exclude all of it. Qualified real property business debt. So if the debt was incurred to assume to acquire, construct, reconstruct, or improve real property that's used in a trade or business, and you have to manage out some sort of forgiveness, right? Like, oh, I can't pay it. Can you forgive part of the debt? You can exclude that cancellation of debt income, but what you're going to see is you're going to have to reduce your basis in whatever that property is that was secured by the debt. There was a rule, and there will be a rule, it remains, when student loans are tied to services. So this is kind of the epitome example, is the doctor goes back to medical, or the student goes to medical school, he gets a degree, he agrees to go work out in like a reservation for Native Americans where there's just no medical services available. And the state says, hey, for doing that, we're going to forgive your student loans. We'll pay your student loans. That's a classic example of an exclusion where they're tied to services. If you die, they can be excluded, right? Your estate doesn't get tacked with them. And all student loans, as you know, this has made big news as of recently, the $10,000 forgiveness for those that have income below certain levels. That's why they passed the all student loans through 2025 rule, is because they were really teeing up, because they didn't want to forgive all these loans for $10,000 each and then have them be taxable, right? Because now it's not a $10,000 relief anymore. It's like, yeah, we relieve $10,000, but you got to come up with a couple grand in taxes. No one really would be that interested in that. So first they passed the student loan exclusion, and then they passed the forgiveness itself. So there's also an exclusion if the debt forgiveness is related to your primary residence. That's through 2025. So you can't pay your mortgage, and you go to the bank and they negotiate a lower debt for you to continue to service. That's cancellation of debt income, but you can exclude it if it's on your primary residence, at least through 2025. Again, there's this basis adjustment. I mentioned this when it came to the real property that's trade or business. It applies equally to the primary residence rules. You have to then reduce the basis of your asset by the amount that you've excluded. So Betty has $40,000 of debt canceled on some qualified real business property. Her basis prior to the cancellation was $100,000. Now she's got to reduce her basis to $60,000. So when you think about it, that's not an exclusion, because eventually probably what happens is she's going to sell that, and then she'll have to recognize gain, and the gain will be larger because she's had to reduce her basis in the asset. Okay, this is the last one, and it's kind of computationally difficult, so try to bear with me on this one, and we'll see if we can live through it, because it is the last thing. So Damone's a wage earner. He's got $900 worth of California state income taxes withheld from his paycheck in 2021. So that's not uncommon, right? When you work, they withhold state income taxes from your check. So in 2021, he itemizes his deductions, and the total amount of itemized deductions is $17,000. And that's well in excess of the 12. I don't know why that's 4, because in 2021, I believe it was $12,550. So well in excess of the $12,550 standard deduction for that year. And of course, that itemized deduction includes his $900 state income taxes paid. And again, we haven't really done itemized deductions, so it's hard for you to understand the tax benefit rule. But suffice to say, that's an itemized deduction. So April 22, he files his tax return, and it turns out he overpaid, right? That's how the situation generally works. And he gets a refund of $50. So the question is that $50 income? And the way the rules work, the tax benefit rule, is if you received a benefit from the deduction, then you have to include the amount in your income. And well, because he itemized and that $900 was in his itemized deductions, he now needs to include that $50 refund in income. And that is not a reduction of his 2022 income tax deduction. It is truly income. You treat it as income, you report it as income. So if we change the facts slightly, he's a wage earner. He's got $9,000 of California state income taxes withheld from his paycheck. So a lot more, right? I got the standard deduction right on this one. He takes the $12,550 standard deduction, files his tax return. Turns out he gets $50 back, right? So he's over withheld. Again, most taxpayers are in this situation. So he's going to get a $50 check from the state of California. Well, in this case, because he did not enjoy his California state income tax deduction, because he took the standard deduction, he does not have to include that $50 refund in his income. That's the tax benefit rule. If you benefited from it, you include it. If you didn't benefit from it, then you don't have to include it. And that brings us to the end of Chapter 5. Looking forward to some great in-class exercises on Tuesday. Hope to see you there. And, of course, quiz at 7.